Hey, crypto fam! Today we're diving into the exciting world of decentralized finance, also known as DeFi. Imagine a financial system without banks, where you have complete control over your money. That's DeFi in a nutshell. Think of DeFi as money Lego blocks. Each block represents a different financial tool, and you can stack them together to create unique financial products and services. This allows for incredible flexibility and innovation in the world of finance. DeFi is built on blockchain technology, which makes it secure, transparent, and accessible to anyone with an internet connection. No more gatekeepers controlling your money. In this essay, we'll explore one of the most popular aspects of DeFi liquidity farming. We'll break down the basics so you can start putting your crypto to work and potentially earn passive income. Let's get started. DeFi takes the traditional financial system and gives it a decentralized twist. Imagine borrowing, lending, trading, and earning interest, all without dealing with banks or intermediaries. In the DeFi space, these services are powered by smart contracts, which are self-executing contracts written in code. These contracts automate financial transactions, eliminating the need for middlemen. This means lower fees, faster transactions, and greater transparency. Plus, since DeFi is global and permissionless, anyone can participate, regardless of their location or credit score. DeFi is still in its early stages, but it's growing rapidly. New projects and innovations are popping up all the time, making it an exciting space to watch and participate in. Before we jump into liquidity farming, we need to understand liquidity pools. These pools are the foundation of many DeFi applications, including decentralized exchanges or DEXs. A liquidity pool is basically a big pot of cryptocurrency locked into a smart contract. These pools are used to facilitate trading on DEX. Instead of relying on traditional order books, DEXs use liquidity pools to provide liquidity for trades. Let's say you want to trade your Ethereum for some Bitcoin on a DEX. You would interact with a liquidity pool that contains both ETH and BTC. The smart contract automatically executes the trade based on the current ratio of assets in the pool. Liquidity providers, also known as LPs, are the ones who supply the crypto to these pools. By doing so, they earn a share of the trading fees generated by the pool. This is where liquidity farming comes in. Liquidity farming, also known as yield farming, is like putting your crypto to work for you. By providing liquidity to a DeFi protocol, you can earn rewards in the form of trading fees, interest, or even governance tokens. Think of it like depositing your money in a savings account, but instead of earning a tiny interest rate, you have the potential to earn much higher returns. Here's how it works. First, you deposit 2 cryptocurrencies into a liquidity pool. Next, your deposited assets are then used to facilitate trades on a DEX. For providing liquidity, you earn a portion of the trading fees generated by the pool. These rewards are typically paid out in the form of the platform's native token. Section 5. Example farming on PancakeSwap. Let's look at an example of liquidity farming on PancakeSwap, a popular decentralized exchange on the Binance Smart Chain. Say you want to provide liquidity to the Cake BNB pool on PancakeSwap. Cake is PancakeSwap's native token. First, you would go to the PancakeSwap platform and connect your crypto wallet. Then, you would select the Cake BNB pool and deposit equal values of Cake and BNB into the pool. Once you've provided liquidity, you'll start earning trading fees in the form of Cake tokens. The more liquidity you provide and the higher the trading volume of the pool, the more rewards you can earn. It's that simple. Section 6, rewards and risks, what you can earn and what to watch out for. Liquidity farming can be a great way to earn passive income on your crypto holdings, but it's not without risks. Before jumping into a farm, it's crucial to understand both the potential rewards and the risks involved. High APYs. Liquidity farming can offer significantly higher returns compared to traditional savings accounts or even staking. Passive income. Once you've provided liquidity, you can sit back and watch your crypto work for you. Exposure to new projects. Many liquidity pools offer rewards in the form of governance tokens, which can give you early access to promising new projects. Impermanent loss. This is a major risk in liquidity farming, which we'll discuss in detail in the next section. Smart contract risk. DeFi protocols are built on smart contracts, which can be vulnerable to hacks or exploits. Volatility. The cryptocurrency market is highly volatile and the value of your deposited assets can fluctuate significantly. Section 7. Impermanent loss. The DeFi tax. Impermanent loss is a crucial concept to understand in liquidity farming. It's the potential loss you could experience when providing liquidity to a pool compared to simply holding the assets in your wallet. This loss occurs when the price ratio of the two assets in the pool changes from when you deposited them. The larger the price divergence, the greater the potential for impermanent loss. While it sounds complicated, the key takeaway is that impermanent loss is only realized if you withdraw your liquidity from the pool when the price ratio is unfavorable. If the price ratio returns to its original state, you haven't lost anything. To mitigate the risk of impermanent loss, it's essential to choose liquidity pools with stablecoin pairings or assets that have historically moved together in price. Choosing the right farm factors to consider. With so many liquidity farming opportunities available, it can be overwhelming to choose the right one. Here are some factors to consider when evaluating different farms. Total value locked, or TVL. This metric represents the total amount of assets locked in a protocol. Generally, higher TVL indicates greater trust and security. APY and rewards. While high APYs can be tempting, it's important to consider the sustainability of these returns and the risk involved. Platform reputation. Do your research on the DeFi protocol and the team behind it. Look for platforms with a good track record and positive community sentiment. Audits and security. Choose platforms that have undergone thorough security audits to minimize the risk of hacks and exploits. Fees. Be aware of the fees associated with providing liquidity, such as deposit fees, withdrawal fees, and trading fees. Security in DeFi. Keeping your assets safe. Security is paramount in the DeFi space. Since you're responsible for managing your own assets, it's crucial to take necessary precautions to protect your funds. Use a hardware wallet. Store your crypto assets in a hardware wallet, which offers the highest level of security for your private keys. Double-check smart contract interactions. Always double-check the smart contract address and the details of the transaction before confirming any interaction. Be wary of phishing scams. Be cautious of phishing attempts and only connect your wallet to trusted websites and applications. Stay informed. Stay updated on the latest security best practices and potential vulnerabilities in the DeFi space. The future of DeFi, a world of possibilities. DeFi is still in its early stages, but it has the potential to revolutionize the financial industry as we know it. Imagine a world where financial services are accessible to anyone with an internet connection, where you have complete control over your assets, and where innovation is no longer stifled by traditional institutions. That's the promise of DeFi. As the technology matures and adoption grows, we can expect to see even more innovative DeFi applications emerge, offering new opportunities for financial empowerment and wealth creation. Conclusion. Dive into DeFi and explore the future of finance. Liquidity farming is just one piece of the DeFi puzzle. From lending and borrowing to decentralized exchanges and stablecoins, the world of DeFi offers a wide range of opportunities for those willing to explore. While DeFi can be complex and risky, it also presents an exciting frontier for financial innovation and inclusion. By understanding the basics and taking the necessary precautions, you can start exploring the world of DeFi and potentially benefit from this rapidly evolving ecosystem. So what are you waiting for? Dive in, do your research, and discover the future of finance.